if the company doesn't necessarily liquidate, but they have permanently impaired the preferred holders and the common equity holders, that would be a failure mode. How do you manage the risk so you don't have a very large blow up, especially among the larger ones in the market?
Lyn Alden began following MicroStrategy's Bitcoin journey from its inception in August 2020. Initially, the strategy was straightforward, a public company converting part of its balance sheet into Bitcoin. At the time, this was a revolutionary concept. For certain portfolios, especially ones restricted from holding Bitcoin directly, MicroStrategy became a proxy play.
I've been covering strategy since they started their Bitcoin accumulation Treasury strategy in August 2020. I've also been long since then. It's been a small part of my analysis compared to everything else I do. So I focus a lot more on Bitcoin broadly than I do on strategy, MicroStrategy, as well as broader equities and macro, as many people know. And I've, over time, the thesis has changed a little bit. I mean, we kind of see the evolution of it over time. So first I was like, okay, it makes sense. There's finally a stock that will own some Bitcoin. So in certain types of portfolios, you can access that. Then they began levering it, which I found interesting. As they kind of did, I think they're either second or their third tranche of leverage. I was like, maybe it's getting a little bit too levered I'm a pretty conservative investor. But then they started issuing equity because they had a pretty high M-NAV at the time. And I was like, okay, this is actually de-risking it to some extent. They're adding more on their equity side. And I increasingly saw that they're navigating this well. I think the executive team has been strong. So my thesis throughout the 2022 bear market was that they would get through it. They did. And since then, we've kind of seen them shift more from convertibles toward preferred. I continue to be long. For people that follow my research service, I tend to trim the exposure when it hits kind of euphoric levels, like particularly high M-NAVs, and everyone on Twitter X is talking about it. But I've still stayed with a position to let the house money ride. And I think broadly, Treasury companies make some degree of sense because if you have an appreciating asset, and Pierre Richard wrote about this back in 2014, the idea of a speculative attack. And Bitcoin was tiny back then, and he kind of pointed out that as it gets bigger, it's inevitable that we'll see some pools of capital find ways wherever they can to short fiat currency and be long Bitcoin. I think the thing about Treasury companies is they can do it with better types of leverage than most other pools of capital have access to, which is interesting and gives them an edge. And I think that by the end of this cycle, we probably will see some Treasury companies fail. I think there will be low quality ones that get over their skis. So anytime you link leverage with something, you're increasing the risk. I do think the highest quality ones are valid. And this particular discussion happened. So I went on Strategy's earnings call as one of their analysts. And I actually asked the bearish question of the group, which is basically asking about stress testing during the next bear market. Like what kind of bear market are they kind of modeling or thinking about as they design their capital structure? And they provided their answers. And then also I generally agreed that their new preferred, which they're pretty excited about, is I think it's hitting a sweet spot that the market wants. So I expect it to be successful. And in one of my two threads, Andy and I went back a little bit and forth a little bit because I'm generally in the cautiously optimistic camp around these treasury strategies. Depends on the specific company in question and the quality of the management team and everything else. Whereas he understandably has a more critical view, which I think is healthy. I'm certainly critical in some aspects of some of these businesses.
As Bitcoin rallied, MicroStrategy doubled down, not just buying more BTC with cash, but beginning to use leverage. Alden, who describes herself as a conservative investor, was initially cautious. The second or third round of leverage raised eyebrows, but when the company started issuing equity at high market valuations instead of relying solely on debt, Alden saw a strategic shift from risky leverage to risk-mitigated growth. The firm was de-risking while still scaling. She acknowledged the strength of the executive team and the quality of their execution. Through the 2022 bear market, her thesis held MicroStrategy would survive, and it did.
You're paying a premium over the Bitcoin they have, but then you're also expecting this per share Bitcoin to increase. Now, there's different ratios that analysts have come to use, basically trying to figure out how much of an M-NAV to apply based on forward, how much they expect Bitcoin increase per share. I've actually raised the concern that the problem with that is it's recursive, because the higher their M-NAV is, the faster they can increase their Bitcoin per share. And so that flywheel is really good on the way up, but can also just unravel very quickly when sentiment changes. It's different than, say, evaluating a company based on cash flows from operating a pipeline business or something. And so while there's merit in that analysis, it's a new form of analysis, and it's inherently just challenging. My general view has been that I don't know what the right M-NAV is. It certainly depends on the company. For example, Metaplanet is smaller, is in a jurisdiction where there's a really big tax arbitrage, which is different than the United States. So that they're actually tax advantaged there. And they started from a smaller base, so they've had very high M-NAV and have grown very quickly. It's come down more recently. So I think that M-NAV is somewhat context dependent, partially based on how much you expect them to be able to kind of arbitrage this. Generally speaking, as they get bigger, we should expect the M-NAV to gradually compress, because trees don't grow to the sky. Now they can continue growing, it's just that after a while, that M-NAV generally starts to compress. That's so far what we've seen in the market. But I do think that an M-NAV above 1 makes sense when you can attach this longer duration debt to Bitcoin, and therefore get through periods of cyclicality, at least if managed well and conservatively, compared to the way that hedge funds lever, the way that retail investors might lever. And so I think it's worthy of a premium. I would like to see eventually more cash flow generating businesses have Bitcoin on their balance sheet. The kind of history of this space, so MicroStrategy did the approach. They actually then ran a number of conferences called Bitcoin for Corporations, trying to get other corporations to do it. We saw Tesla dabble in it. Block got in to some extent. We didn't really see a lot of other companies with existing operations decide to add Bitcoin. Instead, in this cycle, we've seen a number of companies that kind of spun up to do the strategy, as well as increasingly around the margin, some existing companies do it. So I think there is a bigger market for companies that just use Bitcoin as a treasury asset while also having separate cash flows. But then clearly there has been demand for 5 years now, and I think ongoing, for a levered kind of pure play Bitcoin entity. And then I think the main questions to ask are, how do you value that? I generally err toward conservative. And 2, how do you manage the risk so you don't have a very large blow up, especially among the larger ones in the market?
The market has matured. Bitcoin now has sufficient liquidity for corporations to buy without severely disrupting the price. Regulatory clarity, while still developing, is far better than it was even a few years ago. Tax treatment is improving. It's no longer a fringe asset, it's entering the mainstream of financial strategy. Importantly, Alden emphasizes, Bitcoin treasury strategies are not for everyone.
In your asset mix, it doesn't apply to Bitcoin, which is a digital commodity. And so the combination of high expected returns based on those who, generally speaking, those at strategy and those who invest in strategy, are bullish on Bitcoin. So I certainly wouldn't recommend a Bitcoin treasury strategy holding for those who just aren't particularly. I mean, I employ a number of analysis methods to determine what I expect Bitcoin to do. I still think that the total addressable market of what Bitcoin can address is much larger than the current size. In my expectation over the next 5-10 years, I do expect Bitcoin to still have high returns. Now, not the returns that when you go from $1 billion asset to $1 trillion asset, but I certainly think it can 5x and 10x from here, and we'll see how the numbers shake out in the years ahead. And it's also the risk situation is different than before. So when Bitcoin was tiny, it didn't even have the liquidity for like a corporation to buy it. It didn't have the regulatory clarity in many cases either. And so now that the tax treatment of it has improved, regulatory clarity has improved, and it's a big and liquid enough asset, the expected forward returns are not as explosively high.
As Bitcoin's next chapter unfolds, MicroStrategy will remain in the spotlight, not just as a bold mover, but as a test case, a live experiment in corporate monetary rebellion. Will others follow? Will they survive the next bear? And more importantly, is Bitcoin ready for the weight of the corporate world?